Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And it is my real honor and privilege to bring you another of our FastGraphs Value U Academy introductory videos. The video we're going to do today, we're going to talk a little bit about investor psychology. This will be a subject we'll be covering in our Value U Academy curriculum. And we'll be getting into a lot more detail. We just kind of want to introduce the concept because one thing that we're all about at Value U is valuation, how valuation works. But the reality of it is valuation does not always work perfectly. For example, if I look here at Albemarle, which is one of the leading lithium producers, which obviously, it's been involved with the green revolution, if you will, the lithium batteries and energy and green energy, etc. But what I want you to notice about this stock is if I go all the way back to 2001 here, I want you to notice the orange line is the earnings line, the blue line is the normal market valuation, so we've kind of got a range of value depicted here. But if you look at the stock price, the monthly closing stock price, you can see that they followed and tracked earnings very well. Then we had the green revolution, Tesla stock got real hot. Lithium got real hot. And of course, then the company did have a couple of really good years of earnings growth, I might add. And the stock got really well ahead of itself. And then all of a sudden, what happened was the supply of lithium kind of caught up with the demand. And the company even postponed the opening of one of their lithium plants, I believe, in South America. And make a long story short, we saw the price of the stock collapse. But then since then, we've got Tesla going on another tear, and we got the new Green Deal becoming even more and more prominent in our everyday lives, and all of a sudden we see the stock price rise. Well, this is rational stock pricing based on fundamental value. There's always going to be a little deviation, but these are periods of significant irrational pricing or overvaluation. And so in a money management firm that I founded, we named it Earnings Determine Market Price in the Long Run, or EDMP. But there was also an evil twin sister EDMP that said emotions determine market price in the short run. And what happens is the market will misappraise the value of stock. Sometimes it undervalues it and sometimes it overvalues it. We see this with tech stocks today. Here's Apple. Look how the stock price correlated to the company's earnings results or earnings growth historically. And then all of a sudden, just here recently in the last year or two, we've had this major separation from earnings growth. We see a similar thing going on with Microsoft. Now, there's a lot of talk about the cloud with Microsoft, for example, and for that matter, even Apple, and how these companies are reinventing themselves and their earnings growth. And if you look at this Microsoft example, once again, when the stock was overpriced back in 2000, you see a long extended period here of really dead money. I'll calculate that for you real quickly. From June of 2000 through March of 2009, you'd have actually lost half of your money holding Microsoft. And I want you to notice this was a time when the company's earnings actually were growing and doing quite well. The problem was the market was misappraising. Investor psychology had overhyped this tech stock back in the irrational, exuberant tech bubble era. And then, of course, it took over a decade here for it to correct itself. And then, stock price stayed in a very low valuation level here coming out of the Great Recession. And all of a sudden, we see this surge. I want you to notice the slope of the line accelerates here. So we've got the growth of the company definitely accelerating from the 10 or so % growth rate. And if I shorten the time frame, growth more recently has been averaging something like 17 or 18%, which is obviously significantly higher. Going back a little further to 2015, it was 14%. And you can see those numbers here at the bottom of the graph. But the point is, this level of earnings growth, as good as it is, does not support this higher price. So investor psychology comes into play here. And investors definitely will overhype a stock. Emotions will dominate stock price in the short run. But one of the keys here is trying to understand investor psychology. So I've asked Professor Nathan Mock to come in and talk a little bit. It's a subject that he likes to talk about. And he's going to do a presentation here for you on some of the basic investor psychology errors that people tend to make.
Thank you, Chuck. I wanted to start off with a couple questions that don't seem to have much to do with investing, but I think are kind of interesting to think about. And so this first question says, imagine that you're in a room with 100 random people, and if you just compare yourself to those people in the room, would you say you're an above average driver or a below average driver? Just kind of make that decision in your own mind, and we'll come back to that here in a minute. The next question is about the distance from the Earth to the Moon. So obviously you just Google this and find the answer, but just based on what you know, come up with a 95% confidence interval that you think contains the true distance between the Earth and the Moon. So you have a low range, you have a high range, and you're saying, I don't know exactly what it is, but I'm 95% sure the actual distance between the Earth and the Moon is in this range. Just kind of keep that in mind too. So a couple of kind of seemingly random questions not having a lot to do with investing, but it points to a couple of behavioral biases or cognitive biases that are pretty well established and very much related to investing. So the first is called illusory superiority, and this is the tendency to overestimate personal qualities. So going back to that driving question, people have done this type of experiment many times, and it usually comes out to be something like 90% of a group will say that they're an above average driver, which of course, if everyone in the room is either above average or below average, then 50% are truly above, 50% are truly below. But the point is that 90% of people think they're above average. So of course, some of those 90% are correct. They actually are above average drivers, but a lot of them are actually not above average drivers. And so this is a phenomenon that shows up in many ways, and I'm sure you'll be surprised, as I was, to see the next one, which is they did something similar with professors and asked if they thought they had above or below average IQs compared to other professors. And 94% say they thought they had above average professors. So shocking, I'm sure, to everyone that that's the case. The next bias is really going back to the distance in the Moon confidence interval, and the bias is called overconfidence, which in kind of behavioral bias language means thinking that you can estimate something with greater precision than you actually can based on the uncertainty of the event and your own knowledge. And so the actual distance from the Earth to the Moon is about 239,000 miles. I've done this many times. I never remember that number. It's no big deal to know that. I mean, it's kind of a random fact. Maybe you know it, maybe you don't. But that's not really the issue. The issue is if you don't know something, like even at all, then you should have a really wide confidence interval. But people tend to come up with a much more narrow confidence interval than they really should from a rational perspective. And so these are a couple of traits that are very common and pervasive to a whole bunch of decisions. Of course, the decision that I'm most interested in is investing. And so what this means is if you think about maybe overestimating your abilities in general, that can show up into investing generally, but there are some specific tasks that are particularly vulnerable to these types of biases. So in general, we know that predicting the future is a challenging thing to do, but if we tend to use too narrow, if we're too overconfident of a confidence interval, or we just in general think that we have a superior ability at doing it when we actually don't, that can lead to failure. And related to that, there are things like market timing. So trying to buy at exactly the right point and sell at exactly the right point and thinking that can be done with a lot of precision. And it might also impact our view towards things like risk management. So, how careful do we need to be in the event that we're incorrect? And I would say, the big issue is stock picking. So, thinking you have a superior ability to pick winners and losers, which you very well may. Again, by definition, if everybody is either above average or below average, half of people really are above average, but just being careful that we don't think we're in the above average group when possibly we are not. And then the overconfidence shows up definitely on anything that has to be forecast. And so some common forecasts we make as investors are earnings, macro events, and just kind of general trends in industries and maybe even trends in stock prices and market price movements. So it's great that these biases exist and we understand maybe it could cause us some problems, but what do we do about it? I think the first thing that we do is just be aware that this is pretty common to humans generally. And we just want to be really clear that we're probably not immune to these and other biases. And our best defense against that is to really have a process for investing that is based on sort of prudent principles, that's logical and analytical, and that we take a look at that process regularly to make sure that our process protects us against some possible biases that we might have. And some even more specific things to do, I would say one of the big drivers, of course, of stock price in the long run is cash flow generation. So the more cash a firm generates, the more valuable it is. And even though stock prices might deviate from that fundamental truth for periods of time, maybe even long periods of time, eventually that result holds. But still, it becomes very critical then, if that's the big driver of value, cash flow generation, then estimates about earnings, cash flow, revenue, whatever you want to look at as your proxy for cash flow are really important. And it's necessary to make specific predictions about what's going to happen to cash flows if you want to have a real rational process for investing. So it's good to make those predictions, but I think it's good to treat those as a range, like a confidence interval, where we're not thinking we can be overly precise. And then when we set that range, we just need to have some humility, for lack of a better word, that we don't maybe know really certainly what's going to happen. There are a lot of macro events, industry events, and firm-specific events that could disrupt what seems like a pretty logical prediction. So we just want to be sure that we consider a range of estimates when we're making decisions. And by making very specific predictions on a lot of things when we invest, but especially on cash flow generation, this allows you to go back and see how well you've done. It's easy to just fall into price action and say, I bought this stock, the price went up, so therefore I was right. I think it's probably a better process and will lead to better long-term results if you really go back and say, specifically, what did I think was going to happen with earnings, with cash flow, and what actually happened? Was I reasonably close? And, what did you get right? What did you get wrong? And importantly, is there anything in your process that you can change? So hopefully it's useful to just be aware of a couple of the behavioral biases and maybe think of others that could impact your ability to make good investment decisions, and then to really build a data-driven, logical process around investing that helps protect you against some of these biases.
Thanks, Nathan. That was really insightful to be able to illuminate on some of the behavioral biases that people have. It really brought to mind one of my favorite Warren Buffett quotes, where he pointed out that it's better to be approximately right than precisely wrong. And this idea that you brought up about having a range where you have a very high certainty that your range is correct is very, very important. As investors, it's critically important that we know thyself. And when we get these really crazy extended valuations where the price has totally separated itself from its fundamental values, it's very important as investors to be aware of that, so we understand the risks we're taking as well as what the future potential might be, because in the long run, fundamentals real rule, and fundamental values are critically important in understanding those. But again, it has to be done within a reasonable range of accuracy. You can't expect to be perfectly precise. But understanding ourselves and our biases is one of the most important things we as investors can strive to do. Thanks again, Nathan. Appreciate it.